Now, I think my task is to talk to you a little bit about the recovery in the aftermath of the Easter bombings. And then I'll finish with a few remarks on what we are trying to do in terms of putting in place frameworks to strengthen our macroeconomic policy making. Now, as far as the recovery after the events in April are concerned, I'll start with very few remarks on security. I mean, that's way above my pay grade. But clearly, it has become crucial that the security situation is normalized. And there, I think, one can, with some degree of confidence, now say that the security forces have done an excellent job in terms of normalizing the situation. The fact that the Easter Sunday bombings were carried out by a small group of people who did not even have the support of their wider community clearly has made it a much more containable problem. It's different from the problems we've had in the past in that sense. And so, from all accounts, we have actually made significant progress in containing that problem. And it was also encouraging that when it came to the disruptions, there was civil commotion that came about a couple of weeks after those bombings. It was encouraging that really from right across the spectrum of Sri Lankan society, there was widespread condemnation of those kinds of actions. So that I think also, because talking to investors, in some senses they were possibly even more concerned about those disruptions because they're quite used to bombings in different countries. And they feel often these are one-off things that countries can get over. But when you have a more generalized breakdown of law and order, that makes them more nervous. But the fact that the security forces moved very decisively and the fact that right across our society there was condemnation of those attacks has meant that we have been able to come up with a pretty convincing narrative, which I think by and large seems to have calmed investors. So that's on the security situation. Let me also say that the key message that I'm going to try to sell to you in my remarks is that while the impact of the Easter Sunday bombings and the subsequent events is significant. I'm not going to try to underplay that, but it is also, in my view, clearly manageable. So that's really the narrative that I want to develop, that this is a manageable challenge. So the impact from these events can be transmitted to the economy through several channels. There's going to be transmission through the impact on output and growth, through the impact on the external account, balance of payments, through the impact on prices, through the impact on the fiscal outcome. So right across the board, there will be some impact and adverse impact, but as I said, throughout I'm going to try to argue that this can be managed. Obviously, things would have been better without these events, but now that they've happened, we can manage them. So let me start by saying the fact that our macroeconomic fundamentals were in pretty good shape. In the first quarter of this year, if you look at the various indicators, the macroeconomic fundamentals were okay. And that has helped us to absorb this shock without too much disruption. And the fact that the macroeconomic fundamentals were fairly sound is borne out by the fact that on the 13th of May, the Executive Board of the IMF approved the 5th review of the extended fund facility that we have with them. Now, if the fundamentals were not sound, they certainly would not have gone through with that approval. And not only have they approved the review, the report on the review, but they have also, if you have come across some of the narrative that has come out of the IMF following that decision by the Executive Board, it has been helpful and supportive. The IMF has indicated that they do not see any challenges, or at least unmanageable challenges, in terms of Sri Lanka being able to mobilize the refinancing that it requires externally. They also do not see any major risks in terms of our capacity to meet our obligations. So having that endorsement from the IMF at this point is clearly extremely helpful. But of course they go on to say that we must persist with our reforms, we must persist with fiscal consolidation, the central bank must be prudent in terms of monetary policy. All the normal strictures are there. And we are still on a journey. We haven't really got to where we need to be as far as macroeconomic management is concerned. But really the approval of the review of the EFF and the subsequent statements by the IMF have been helpful. Then if we, I must say that when I made these remarks at another forum, the person said it's very revealing that in my position I start by saying that the IMF approves of us. But anyway, it is, in our situation, it is useful to have their approval. Because without their approval, we will not be able to raise the kind of money we need to keep ourselves solvent. What about growth? So I told you there were these various channels. So let me take each of them in turn. There's clearly going to be a hit to growth. At the beginning of the year, at the central bank, we projected that growth for 2019 would be 4%. It was 3.2% in 2018. I should, before I go, by way of a footnote, let me talk to you, because this is an official group, about some concerns we have in the central bank about the growth data. Last year, the Census and Statistics Department came out with an official growth figure of 3.2%. In our view, the figure was closer to 3.7 or 8%. And if you look at the multilaterals, the IMF, the World Bank, the ADB, and even the research outfits of commercial banks, all of them were closer to 4 than they were to 3.2. Now, the problem here is that a few years ago, the Census and Statistics Department adopted a new methodology for computing the national accounts. It is a very, very good methodology. However, it needs a lot of survey data to support it. And they haven't been endowed with sufficient resources to undertake the surveys that they require to make this methodology work as robustly as it should. So instead, they are compelled to use various proxies. And in our view, those proxies are not picking up some of the newer activities in the economy, which is why we feel that the growth is understated. But having said all that, the central bank's projection for 2019 was 4%. Now, our latest revision, we have not gone public with this, but we think that growth may come down to about 2.9%. That's our best guess. It is still very early to fully understand the impact of the Easter events, but that's where we are coming out at now, coming down to about 2.9%. So that's really the impact, and most of the most severe impact is clearly tourism. I'll talk a little bit more about that later. But when you talk about tourism, I mean, it's about 5% of GDP. And of course, tourism has this whole ecosystem. There are all these supply chains related to agriculture, related to transport, related to handicrafts, related to other leisure activities. So there is this whole ecosystem, all of which has got affected. And in addition, the loss of sentiment, I mean, the adverse impact on sentiment and the loss of confidence. Because people, I hope it's recovering now, but people at some point were of the view that the government was not able to protect them. And that had a very, very severe impact on sentiment and confidence in the country. And for some weeks, I think up to Vesak, there was a disruption of a lot of activities. And that, fortunately, after Vesak, one gets the feeling that this is beginning now to turn, and we have achieved a fair degree of normalcy. But that 3 weeks, 4 weeks or so there was quite a severe disruption to economic activity. Now, the upside narrative is that if you look around the economy, the productive capacity of the economy is very much intact. Agricultural capacity has not been affected. I know of only one manufacturing installation, that was that pasta factory in the northwest, that was affected. Other than that, all the industrial installations, manufacturing installations, were not affected. Some retail outlets were affected in Negombo and in the affected areas around Putlam. But, you count all that up, it's still a very minuscule part of the productive capacity of the economy that has been directly affected. So if confidence, if sentiment turns and confidence comes back and people get back to work, the economy can bounce back. So that is the kind of upside narrative which I think will mitigate some of the negativity and the losses that we incurred in those 3-4 weeks between Easter and Vesak. So that's the growth story. Let me next turn to the another part of the positive narrative, which is the impact these events have had on financial markets. We have had 6 Treasury bill auctions. The central bank has conducted 6 Treasury bill auctions on behalf of the government since the 21st of April. On each of those occasions, the yields on the Treasury bills have come down. And in fact, since the 18th of April, which was the last working day before the Easter bombings, the 1-year Treasury bill rate has come down by about 102 or 103 basis points. So that's one positive development. And in these past 6 weeks or so, we had the largest bond issuance, Sri Lanka government bond issuance, an issuance of 120 billion rupees took place about 3 weeks ago. And there again, the yields came down. So the financial markets did not lose confidence. They were willing to buy government paper at a cheaper price, at a lower yield. Our international sovereign bonds, we issued a 5-year, a 2-tranche, 5-year, 10-year bond in March. The 10-year bond at 8.75%, the 5-year bond at 7.75%. On the 18th of April, those bonds were trading about 60 to 80 basis points lower. So as I was telling you, the story about the relatively strong macroeconomic fundamentals in the first quarter of this year, this was again another indication that the macro indicators were in reasonable shape because our bonds actually tightened by 70 and 80 basis points. After the 18th of April, we have seen these bonds widen again. And they're now trading at a rate at or marginally less. Actually, it's now, I think yesterday it was marginally above the price that we had to pay in March. Still, the price has not gone above the yield that we had to pay in March, which indicates that markets are still open to us. And I'll say a little bit more about that later. So that is, again, as I said, the positive side is, one, the productive capacity of the economy is very much intact. It can bounce back. The challenge is confidence and sentiment. Whether we can really get that back before another election, that's a question mark. But if we are able, there's no reason why it can't bounce back, and it will. The extent to which it will bounce back remains to be seen. And the financial markets, the impact on the financial markets have been well contained. What about the external account, the balance of payments, which historically has been our Achilles heel? That's where the crises normally emerge, when we have pressure on our balance of payments. Now, last year we had a lot of stress on our balance of payments. Part of it was exogenous, externally determined. The US Fed was tightening interest rates. Money was flowing out of emerging market countries, particularly countries with a current account deficit like Sri Lanka. Several countries, India, Indonesia, a number of countries in the region had the same problem. Our currency depreciated by 16%. We had about $1 billion flowing out from our government securities market. So there was an enormous amount of stress. And the causal factors were, I've identified the external factors like the US Fed action, oil prices, trade tensions, and the strong dollar. Those were all problems beyond our control. In addition, there were two domestic sources of pressure. One was gold imports. We reduced the duty on gold to zero. The objective was to promote the local industry, but that created an opportunity for arbitrage because duty in India was 15%. And given the voracious appetite for gold in India, people started importing gold duty-free into Sri Lanka and smuggling to India. And gold imports, which were running at about 150, 200 million, suddenly went up to 600 odd million in 2018. And in the first 3 months of last year, they were going at a rate where it would have exceeded $1 billion, starting from about 100, 150. So the government increased the duty to 15%, took away that arbitrage opportunity. Gold imports have come down and come down dramatically. The other source of pressure was the duty reduction on motor vehicles, particularly small vehicles. Again, there was a combination of duty adjustment and various macroprudential measures that the central bank took. And again, we've seen motor vehicle imports. Motor vehicle imports, which had increased by over 100% by September of last year, since October, November, have come down very sharply. And all that has meant that in the first quarter of 2019, our trade deficit, which was $3 billion in 2018, came down to $1.7 billion. So a significant, quite dramatic reduction in the trade deficit through a combination of both import reduction, particularly gold and motor vehicles. Also, the oil price moved in favor of us. That also helped us. And, of course, the various measures taken against non-essential imports and the 16% depreciation of the currency. That also had a significant impact. And we've seen this very big adjustment in the trade account, which has meant that before these events, we anticipated that the current account deficit, which was 3.2% of GDP in 2018, would come down to 2.3% of GDP. But now, the impact on the current account is, on a net basis, going to be such that we are tentatively estimating, for the moment, about it's going up. Our projection is going up from 2.3 to maybe 2.7, 2.8. Why is that? The improvement in the trade account is likely to be offset by the deterioration in the services account, particularly tourism. Tourism receipts, which were projected at $5 billion, are now being projected at $3.7 billion US. So there's a 1.3 billion reduction in tourism receipts and a reduction in arrivals from 2.6 million projected initially for this year down to about 2 million, 2.6 million to 2 million. So that reduction, and there's also likely to be some impact on the transportation sector because imports are coming down significantly. Therefore, the shipping side of things can also get affected in the services account. Airlines, again, could get affected in the services account. Given all that, we think there's going to be some deterioration in the current account deficit up to 2.7, 2.8. If we are able to contain it at that level, which we think we should be able to, it would still be an improvement on the 3.2% of GDP last year. So there would be some adjustment in the right direction in the current account deficit. So again, yes, things are worse than they would have been, but they are containable. Now, let me just quickly run through what might be. I should also say that the improvement in the trade account, of course, import compression is a significant part of the story, but quietly, there has been a very steady growth of exports. Both in 2017 and 2018, in absolute dollar terms, we had record levels of exports. And the first 3 months of this year, again, exports grew by 4.5%. So we are seeing this underlying improvement in exports, which is continuing, and there is no reason to think that exports should be materially affected by the impact of the Easter bombings and its aftermath. So that's really the story on the external account. I should also say the exchange rate, which depreciated by 16% in 2018, up to April 2018, appreciated by 4.6%. So that's again another indication of the underlying fundamentals improving. After the events, they depreciated, the currency was under pressure, but now we find that again it is stabilized, and year to date the appreciation is now about 3.6%. At April 18th it was 4.6, now it is 3.6. So some depreciation, but again the situation seems contained as far as the rupee is concerned. Also in terms of foreign institutional investment into the rupee securities, there again I said last year, if you remember, I said $1 billion flowed out. This year it's about minus 75 million so far. There were some capital outflows, but it again seems fairly contained. Now I'm going to share with you because really the external viability of the country is the real problem, because in terms of domestic obligations, I mean, if worse comes to worse, the central bank can print rupees and you can pay them. I mean, central bank is no longer printing rupees, but there is that option. External viability clearly, becomes much more of a problem if we default. And Sri Lanka has never defaulted on a single payment. And this is something that markets have really absorbed. Just last week we were talking to some bankers who said, look, we have been talking to our clients as were they interested. They said, yeah, we are interested in Sri Lankan paper even now despite all this, because we know they will do whatever it takes to meet their commitments. So that is a good reputation to have, and it's a reputation we have to maintain. Now, I'm just going to sketch out a worst case scenario for you, just to show that things are containable and manageable. And these numbers I'm kind of picking out the top of my head, okay? It is, I hope, reasonably sensible, but they're not based on analytics. So what are the negatives? We said that the tourism receipts will come down by 1.3 billion rupees. Now, the tourism sector has about a 20-30% import component. So let's say that net hit on the tourism sector is about $1 billion, $900 million by $1 billion. Then the other sources of leakage are, one, the foreign institutional investment in rupee security. Now, we have in total about $900 million of foreign institutional investment in our government rupee securities. And as I said, only about 70 million have gone out this year. Let us assume about 300 million. There is no reason to believe that at the moment, but just in case, just for the worst case scenario, let's say about 300 million. A third of that flows out. So that takes us to about 1.3 million. Then the other possible hit can be to foreign direct investment. Now again, we've had 2 consecutive years of record foreign direct investment. And both for exports and FDI, there is nothing to write home about. Okay? There are 2 record years from a very, very low base, and the performance is still very, very poor. But at least they were records for us. We compare it with Southeast Asia, and we're still very, very bad. But we were going in the right direction. FDI, again, we had 2 record years, 2017, 2018. Projection for this year was $2.7 billion USD. after 2.3 billion last year. But let us say about 700 million of that doesn't come in, because it'll get slowed down. I saw Mangala Yapa being quoted. He's right. I mean, the inflows this year would be based on agreements that are already signed. But there could be some slowdown, which could reduce the inflow this year from 2.7 to 2 billion. So you add all that up, 700 million, 300 million, and 1 billion, you lose about 2 billion, let's say. It won't be that. This is really the worst case scenario that I'm sketching out. Now, on the 18th of April, our projection for the reserves for this year was US dollars 8.2 billion. If you take 2 billion off, it comes down to about 6 billion, 6.2 billion, which is not a great level of reserves, but it's perfectly adequate. It's about 3 months import cover. In the past, we have worked with 4 and 5 weeks of import cover over the years. So 3 months import cover is okay, not great at all, but so we can manage. Even in the worst case scenario, the point I'm trying to make is we can manage. However, and this is a big however, that 8.2 billion, which I spoke about as the projection for this year, has built into it us raising 2 billion US dollars more from international capital markets by way of bonds or borrowing or loans, term loans. So that has to be done. So we have to do that to be able to end up with 6 billion in the worst case scenario. And there are plans to do that. Fortunately, as I said, the IMF have said they don't see any refinancing problem. That has been helpful to us. The conversations we've had with banks, with investors, it seems they're still interested in taking on Sri Lankan government paper. So hopefully, we will be able to raise money. The cabinet has approved the issuance of international sovereign bond, 1.5 billion US, which can be upscaled given market conditions to 2.5 billion. In addition, the cabinet will consider next Tuesday a cabinet paper seeking approval to raise up to 480 billion rupees, the equivalent of 480 billion rupees, under the Active Liability Management Act. There was this new act in 2017 which now allows the government to borrow over and above the borrowing requirement built into the Appropriation Act. Now you can borrow extra money just for liability management. It can't be used for anything else, but you can borrow money just to manage liabilities, which has given us much more flexibility and headroom in terms of managing our external debt. And so we are seeking cabinet approval for the first such operation. And provided the cabinet approves it on Tuesday, the coming Tuesday, the way will be open for us to go to raise an international sovereign bond, and then we'll have options in terms of what we do. It could be a samurai bond, and JBIC are willing to guarantee that for us. It could be a panda bond. We've spoken to the People's Bank of China, who've said they will be willing to assist us. Or it could be a term loan. At the moment, we are thinking of a term loan because the World Bank has offered us a new instrument they've now got called a policy-based guarantee. They have set aside 250 million US dollars, which can be leveraged 4 times up. So we can borrow up to $1 billion US dollars on a World Bank guarantee. And what is the benefit? We borrow that money on the World Bank's AAA rating, not on our rather weak rating. So that will save considerable amount of money in terms of raising up to about $1 billion. So all these are plans that my colleagues are working on with their Treasury colleagues. And over the next 2, 3, 4 months, this money will be raised. And as I said, I think we'll be able to meet our external requirements. So that's essentially it. The last channel is the fiscal channel. There are some challenges. On the revenue side, with lower levels of economic activity, the VAT take will be affected. The income taxes will be affected. The import duties will be affected because of the imports coming out much lower. So the government on the revenue side is going to have quite significant challenges. On the expenditure side, Of course, there will be some security-related expenses. There will be some compensation payments. So on the budgetary side, there are some significant challenges. The Treasury is reworking the budget. They're going to reprioritize and try to accommodate as much as possible within the current framework. But having said that, and here I think this will be of interest to you, the donor community has indicated that they may be interested in supporting, and the World Bank has indicated that they are willing to undertake a donor coordination exercise to see what money can be raised. The Treasury, once it's finished its review, once it's identified areas where it requires money, then there will be, hopefully, some donor support that can be mobilized to address the slippage that is inevitable as far as the government's budget is concerned. So that is essentially the kind of a little roadmap of what the challenges are. But as I said, yes, there will be adverse effects through these various channels that I've spoken to you about. But each of them, when you look at them carefully, I think they are manageable. And in the longer term, I should very quickly say that, if you look at what has happened to us from independence, we were second to Japan on almost any indicator in Asia. We're dropped down quite a long way now. And complex causality, economic, social, political. But in my view, arguably the most significant causal factor has been macroeconomic stress. Continuously from the late 1950s onwards, we've been subject to macroeconomic stress. First, because of the decline in the terms of trade, the prices of tea, rubber, and coconut came down on a secular basis. There's a box in the 1982 edition of the World Development Report, the World Bank's World Development. They have a box on Sri Lanka, citing Sri Lanka as a classic example of a country that had been buffeted by severe terms of trade decline. Then, from the kind of 80s onwards, we had to accommodate a large amount of defense expenditure, clearly. And in the process, we also had to give a lot of concessions to get investment going in an economy which had a very high war risk premium. All that meant that the budget was out of kilter for long periods. First the balance of payments, then the budget. We are a classic twin deficit country, and that has put macroeconomic stress in the system. So we have to move away from that. So there are 4 frameworks. The central bank is introducing a flexible inflation targeting regime. I can talk more on that if you like. And there's going to be a new Monetary Law Act, which will prevent the central bank from printing money. I did say that if we get into trouble, we can print money. We can today, but hopefully after July, we can't, because that new law has been approved by Cabinet, and it's with the legal draftsman. I think they've given it back to us. So hopefully, we can get it back to Cabinet and into Parliament in the coming weeks. And if the new Monetary Law Act is introduced, the central bank will not be permitted to operate in the primary auctions of treasury bills. And what that means is we don't print money. We can't print money. The government has to raise its money and spend. And we'll have much more discipline. In the past, whenever the government wanted to have a bust up, they forced the central bank to print the money for it. And that has happened many times under all governments. Hopefully that will not happen again after July. That's one framework. And also we will manage the exchange rate flexibly. In the past, we've tended to have an overvalued exchange rate, which is why our export performance has been so poor, one of the reasons. And essentially through the exchange rate, we were subsidizing foreign producers at the expense of our producers, and domestically consumers at the expense of producers. So this is something that hopefully we won't do again, because as part of this flexible inflation targeting regime, you have to have a flexible exchange rate policy. Then the third framework is fiscal consolidation. We have a Fiscal Management Responsibility Act, which has certain rules. We have broken the rule on every year since we introduced the Act. So we are trying to strengthen those rules, and that will also go to Cabinet within the next, I think we have to get Cabinet approval by the end of this month. So if we strengthen those rules, hopefully the government's fiscal consolidation will also stay on track. See, what we're trying to do is introduce these frameworks and to institutionalize them through law to make sure that they're durable. And finally, I talked to you about the Active Liability Management Act, which gives us the capacity now to go and raise money purely for liability management and to build buffers so that we can manage them proactively. So hopefully these 4 frameworks will enable us to have a more robust macroeconomic management, which will give us sound fundamentals on a sustained basis, which is not what we haven't been able to have in the past. Okay, thank you.